Now let's talk about debt instrument. Debt is one of the important component of the capital structure. Debt instrument or debt investment like bonds and mortgages specify fixed payments including interest to the investors. So here, unlike equity, the interest is fixed, because in case of equity the dividend is never fixed. Depending on the profitability of the company decides whether to issue dividend or not. If yes, what amount of dividend to be issued. But unlike the equity, debt instruments will be giving you a fixed amount of interest irrespective of the company's profitability. Debt instruments tend to be less risky than equity investments since the return is fixed, but usually offer a lower but more consistent return. If the risk is low, your expected return has obviously to be low, and that's exactly what debt instrument teaches us. They are less volatile than common stocks with fewer highs and lows than the stock market. Individuals, businesses, and governments are common types of debt instruments like bonds, loans, debentures to raise capital or generate investment income. Debt instruments act as an IOU. When we say IOU, basically what we mean here is IOU. So that's exactly the debt instrument says, that whoever is holding that instrument and whoever is purchased from the company or the government or the company owns that much of amount to that individual investor. So debt instrument act as an IOU between the issuer and the purchaser. In exchange for a lump sum payment, the lender guarantees the purchaser full repayment of the investment at a later date. The terms of these types of contracts often include the payment of interest over time, resulting in cumulative profit from the lender.